Hey there, financial explorers. Ever wondered what makes a stock hard to borrow and why that can sometimes lead to explosive price action, often called a short squeeze? Today, we're diving deep into a fascinating example, CIIT. We'll break down what's happening with this microcap, why its cost to borrow is so high, and what it all means for traders and investors. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Just CIIT ticker and basic stats on screen. Let's talk about CIIT. This is a microcap company, and interestingly, its sector is currently listed as in/A, which can be common for smaller entities or those undergoing transitions. What immediately jumps up when we look at CIIT's recent trading activity is quite striking. Over the last 30 days, including today, CIIT has seen absolutely no price change, holding steady at plus 0.0% today, plus 0.0% over the last 5 days, and plus 0.0% over the last 30 days. And here's another key point, today's volume is 0 shares, with a 30-day average volume of also 0 shares. This means its relative volume is 0x average. In simple terms, there's been virtually no trading activity. Despite this, CIIT has an estimated float of 7.3 million shares. This lack of trading makes its hard to borrow status even more intriguing. What is cost to borrow and why it matters? So, what exactly does cost to borrow mean, and why should you care? When a short seller wants to bet against a company, meaning they believe its stock price will go down, they borrow shares, sell them, and then hope to buy them back later at a lower price to return to the lender. The difference is their profit. But borrowing isn't free. The cost to borrow, or CTB, is the annualized fee short sellers pay to borrow those shares. It's like interest on a loan. When a stock becomes hard to borrow, it means there's high demand from short sellers and or a very limited supply of shares available to lend out. This scarcity drives the cost to borrow fees through the roof, sometimes, as we'll see with CIIT, far exceeding 100% annually. These high fees can become a ticking time bomb for short sellers. Why the stock is hard to borrow right now. Highlight CTB number on screen. Now let's get specific with CIIT. This stock appeared on our hard to borrow screener for a very compelling reason. Its annualized cost to borrow fee is an astonishing 943.6%. Think about that for a second, nearly 950% per year just to hold a short position. While we don't have data on its CTB momentum or the exact number of shares currently available to borrow, the 943.6% figure alone is screaming scarcity. For a microcap stock like CIIT, with an estimated float of 7.3 million shares, even a relatively small amount of short interest can quickly make shares hard to find. Our internal composite squeeze score for CIIT stands at 44.4 out of 100. This moderate score, despite the sky-high CTB, reflects the current lack of volume and price momentum. It's important to understand that a high cost to borrow does not automatically guarantee a short squeeze. It can also indicate that short sellers have incredibly strong conviction in their bearish thesis and are willing to pay almost any price to maintain their positions. However, when combined with a tiny float, it suddenly flags the stock as having a unique dynamic. Squeeze mechanics explained. So, how does a high cost to borrow relate to a short squeeze? A short squeeze happens when the price of a stock starts to rise, forcing short sellers who borrowed shares to buy them back to cover their positions. They do this to cut their losses, or because their brokers demand it. If there are few shares available to borrow, and the price starts to climb, this forced buying creates a feedback loop. More buying drives the price even higher, which triggers more short sellers to cover, causing a rapid, dramatic price spike. With CIIT's 943.6% CTB and its small 7.3 million share float, any significant increase in trading volume or price could theoretically create extreme pressure on anyone shorting the stock. The daily interest alone on such a high CTB would be punishing. Dilution risk check. Before getting too excited about squeeze potential, it's crucial to check for dilution risk. Dilution occurs when a company issues new shares, effectively increasing the total number of shares outstanding. This can flood the market with new supply, reducing the value of existing shares and often offsetting or completely negating any short squeeze thesis, even if the cost to borrow is sky high. For CIIT, our checks found no recent dilutive SEC filings such as SMINUS1s, SMINUS3s, or 424BS in the last 90 days. This means, for now, there doesn't appear to be an immediate risk of the company directly issuing new shares to dilute shareholders, which is a positive factor for any potential squeeze play. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Given CIIT's current unique situation, extreme cost to borrow but zero trading activity, what should you be watching for? The number one factor is volume. Any sustained increase in daily volume, even small numbers, would be a major shift for CIIT. If volume picks up, keep an eye on price action. Even a slight uptick in price, if combined with rising volume and that astronomical CTB, could start to put pressure on any existing short positions. Also, monitor if any data regarding shares available to borrow or CTB momentum becomes publicly available, as it would provide more clarity on the supply and demand dynamics. For now, CIIT remains a fascinating, albeit dormant, example of a stock with extreme hard-to-borrow characteristics. CIIT presents a truly unique educational case study. With an annualized cost-to-borrow fee of 943.6% and a small estimated float of 7.3 million shares, it's a prime example of a stock where borrowing costs are incredibly high. However, its current zero volume and zero price change highlight that while the potential for volatility due to short interest is theoretically immense, there's no active trading bringing that potential to fruition at this moment. It's a vivid illustration that high CTB alone isn't enough. You need underlying trading activity to trigger a squeeze. If you found this breakdown of CIIT and short squeeze mechanics helpful, please hit that like button, subscribe for more deep dives into interesting market dynamics, and let us know in the comments what stocks you want us to analyze next. Thanks for watching, and happy trading.